I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same. Oh wait, I'm missing Tesla. Whoops. My position disclosure is there. There it is. All right. Oh, and I'm missing SPXL. What's going on here? Come on, Derrick, wake up. Okay. Now the position disclosure is fully updated. Bam. There you go. All right, let's dive on in. So the SPY today closed negative by 0.25%. The Qs closed positive by 0.1%. The IWM closed positive by 0.1%. TLT is up this afternoon, so rates are down a little bit. This TLT is almost back to the 80 EMA on the daily after getting really extended to the downside there where we had a little scare last week. And the dollar is positive. Okay, so I mean, really quiet day today. There was no new major headlines that hit. It's a holiday week, so we had a really quiet day. I mean, the quietest day in some time. Yesterday was actually also a little slow and quiet, and today was even tighter. So we have an inside day pretty much across the board. That's fine. I still think that yesterday's high and yesterday's low are important going forward for clarity. This morning, we opened up pretty much exactly flat. So the game plan for today was to take a less is more approach to trading. Don't force things when they're not there. It is possible for yesterday's high to be a pivot high for this market where we work our way down. It's also possible for us to get through that high, challenge 550, and then if we break 550, I think there's the potential of a positioning squeeze to the upside where maybe we get a move up to 560 to 570 that I think is shortable. So that's kind of my, bigger picture mental process right now that obviously is constantly evolving. With that said, we got no further clarity on that today because it was just a quiet inside day, although the S&P did close negative again. So that's kind of the update, I guess, at the index level. Really nothing to talk about. If you look at these SPYs, they're as sideways as they have been in quite some time. Qs and IWM, pretty much similar there. So Qs are also an inside day on the day. And I guess the IWM was not. The Russell, at one point this morning off the open, was showing some relative strength. It got above yesterday's high. Overall, the IWM has been weaker within the confines of this bounce. Like the SPYs and Qs are closer to testing the levels that we broke down from, which for the IWM that'd be like 196. So you definitely still have a lot of weakness here with the Russell to be trading $10 below the level that it broke down from, whereas the SPY, which is a more expensive ETF, obviously is trading is trading like $12, $13 down from where it broke down from. So certainly some relative weakness out there in the IWM. But overall, inside day today, really not too much to talk about. I mainly focused on managing my swings. I took a little bit of an SMCI long trade today in the beginning of the day off these tails. I managed barely to not get shaken out at this low here at 945. Was able to capture this bounce. I put in a trailing stop, and then I got stopped out on the way down on the remainder of it. Netflix was a little bit exciting at a certain point. We actually called for Netflix for a long today. And I think more of us ended up shorting the extension peak here than actually buying it, which is unfortunate because the long through 950 that we discussed in the morning meeting, if anybody took it, was great. Netflix had some sort of buy initiation from Bank of America this morning, and I thought that the technicals just look good. A lot of relative strength here overall, trading near last Wednesday's high, which means it's relatively strong to the market. Few inside days in a row. So what we said in the morning meeting was you could look to be long versus 940 area, or you could look to buy through 950. The momentum buy through 950 was money. The risk on that was relatively low. $2 worth of risk in $1,000 stock is really not that bad, but probably not for everybody. You know, I tend to avoid these really expensive names just because the spreads are wide. I don't really trade Netflix too often. And I also was not involved in the long, but that was the better trade. I mean, this thing, you risk $2, and then 40 minutes later, you were $40 in the money on the trade. I mean, it's pretty darn good. The extension in this thing got a little bit silly. The volume picked up, so I didn't actually take the long, but I did take the short, and the short was much, much, much harder money than the layup long. I was decently out of the money on my trade from where I initially put it on. I averaged down a little bit on it, and then we got honestly a little bit lucky, though I think that this extension would have satisfied itself at some point. We got a little bit lucky that we got hit with like an EU tariff headline. Then it ended up not really mattering too much, but it hit the market down and hit Netflix down a little bit at that point, and we got our pullback to the 80 MA on the daily. Sorry, the 80 MA on the 5 minute, which by that point I got 100% out of the position. I ended up green in the trade, but I made less than I was negative at a certain point in the trade. So it does not make it a great trade from a risk-reward perspective, but I think that this thing really overshot on the upside. There was a huge buyer there that I was able to identify in the tape that was getting filled and continuing to come back at higher and higher prices. But then eventually, you know, this thing gave us the technical pullback of the extension to the 80 MA on the 5, which is all that I was looking for. Got out of the position, made a couple dollars, and that was really it. I mean, the only other thing I did today was I sold a little bit of 0DTE QQQ puts for a $456 strike price into this down move. So I sold them almost at the money into this down move, and was able to get like, I don't know, $1.15, $1.20 on them, and then they expired worthless. That was it. That was all I did. A few small day trades on the day. Nothing too crazy or too big. And outside of that, just kind of managed my positions. Palantir, we also, even though everyone kept asking about shorting it, talked about Palantir as a long in the morning meeting this morning. So if anybody was focused on that relative strength, paid. Palantir traded great throughout the day. It was one of the stronger names that was out there. We talked about maybe trying to buy some of these banks this morning. Sorry, just reading this tariff headline that's coming out from Trump. It does not seem to be moving the market. The tariff pause was because it's a transition and came from the need for flexibility. Anyway, we talked about Bank of America's potential long today. It didn't end up giving any follow-through from the gap up on the report. Citi, which I actually didn't think was as good of a report, it didn't gap up as much as Bank of America, but it probably traded a little bit better during the day today. And that's really it. I don't really have anything else. United Airlines here reporting after hours and is trading up. It's interesting that they gave like a double guidance here, like one that is in a recession and one that if it's not in a recession. And I'm seeing Josh and Bill both saying that they've never really seen that before. I would also say I've never seen that before. It's really interesting that they did that. Really interesting. Really interesting. And I'd be curious to see if we see that from more companies now that they led the way. But yeah, United trading up here after hours, so not too bad. But I really don't have anything else to talk about. It was one of the quieter days that we've had in a while. Oh, by the way, we're not doing an afternoon meeting either of the next 2 days. Tomorrow, I got to go to this T3 quarterly meeting, and I'm going to try to speak with the owner of T3 to make sure that he doesn't do his quarterly. He usually does them in like once a quarter, obviously, but in the middle of the day, and for some reason he changed it to 4 p.m. for this quarter, and I'm going to ask him if he can go back to doing it in the middle of the day again going forward, because I don't like leaving you guys hanging. So there's going to be no afternoon meeting tomorrow, and then we're not going to do an afternoon meeting on Thursday because that is the start of our weekend because the market is closed on Friday. So if you have any questions about anything that you might think that you might ask tomorrow or the day after tomorrow, you want to ask them now. Because that's all I got. I'm not seeing any questions in the VTF for the moment. Over in the YouTube, as you start taking more and more options trades, what do you think it is the easier strategy for collecting premium? So the option trading that I am doing at this point is a very, very, very small percentage of my overall trading. And I tend, because I'm still in a learning process with options, I tend to not necessarily do them huge. I guess I've had a couple that have been fairly big trades. It's like anything else. There's risk reward in trading any product. Options have a different risk reward profile. For myself personally, thus far, I have not had a lot of success buying options, buying calls and buying puts. I have not had a lot of success, and I don't know if that's just because, well, one, I haven't done a ton of it, but two, I don't know if it's because I'm better at predicting where price is gonna go than the timing of it, or if I'm better at predicting where price is not gonna go than where price is gonna go. I've struggled on the options buying that I've done to some degree, just with the theta decay running against me. And honestly, this might just be a trading personality thing. It annoys the hell out of me when a trade works, but I don't really make money on it because it decays away from me. And also, if I'm going to take a directional trade, I'm a prop trader in a prop account. I would rather just buy the underlying equity if I'm going to take a directional trade. Like most people who buy options in like the retail world, they buy options because of the natural leverage that's inherent in the product. I don't need leverage. I have all the leverage in the world. So if I think that something's going to go up, I generally speaking would rather just buy the underlying stock than buy a call option, or short the underlying stock than buy a put. I have had more success with a type of trade that I don't think can be realized in the same way in the equity world, which is basically selling. Uh, honestly, it's not. I'm not recommending this, but I've had a decent amount of success selling naked puts. It might make more sense to sell spreads because you limit your risk a little bit better. But the way that I view selling puts is basically I view it as buying the equity. So I might as well be kind of going long the stock, but instead of buying the stock for an upward directional move, I'm buying the stock knowing that I will make money if the stock basically just goes sideways or stays above my strike price if it's a put that I've sold. Um, I'll just make money because they'll expire worthless. So it allows me to realize a thought process in a way that I can't realize through equities. So like when I sold the QQQ puts that I sold today, again, not a huge trade or anything like that. We were getting down to 456, and basically what I'm betting at that point is that the market is going to stay range bound over the course of these next, less than 2 hours at that point, and not break down further. So I'm not necessarily betting for upside. Like if I bought the QQQ, if I bought the underlying equity here, the only way I'm going to get paid is through upside. So I'm not necessarily betting on upside. I'm betting on lack of downside at that point. And all I need this to do is hold above that strike and they're going to expire worthless. Or honestly, if I brought in like $1.15 in premium or whatever it was, maybe it was $16, $17 on it. Basically what that means is that my break-even price on it is really like 454, like 85 or whatever. So that's my break-even price when I'm doing that. And the ideal situation is basically what happened, where it closes on 456. So again, it allows me to kind of realize a trade in a way that I wouldn't otherwise. So I have found that using technical analysis and being selective in how I sell options has been a really pretty consistently profitable strategy for me. Except I got one nasty lesson that did cost me a bunch of money in options trading when I had some QQQ puts that I sold, luckily not a ton of them, on this day here, the Wednesday that Trump announced tariffs, and I didn't realize that they could still, that the owner of the options contract could call it away from me as late as 5:30 p.m. So back on the second here, I had sold some puts that day. I don't remember exactly what the strike was on it, but my technical idea turned out to be 100% correct intraday. I thought that they expired worthless. And then after the market closed, the market got absolutely destroyed on Trump's tariff announcement. And then the next morning, I woke up to see that I had some long QQQ in my account from, I don't know, 465 or 466 or something, but the Qs were trading at, 457. So I got absolutely smoked in that, but that was really just more. That was the only reason I got smoked on that was just because of my own ignorance as I'm going through a learning process on options trading because I didn't realize that they could be exercised as late as 5:30 p.m., which they can. So yeah, that really sucked, and that lesson actually took away a good bit of my overall profit. But I really don't think I made a mistake outside of just I should have been more knowledgeable on how this stuff works if I'm going to be trading it. But overall, I've gotten hit a couple of times on some stuff, but for the most part, again, I'm viewing it as kind of buying the equity, so I don't necessarily dislike if I get the stock from that price. And then there's other ways you could do it too. You could do it through some sort of a credit call spread or put spread, or you could do an iron condor even. You could get a little more complex with it. But for me, it's primarily just been sometimes I'll sell covered calls if I'm long a stock and I don't want to get out of it, but I think it's reaching a ceiling. Or sometimes I will sell. I don't really ever do naked calls, partially because T3 doesn't allow it. But I will do like a covered call or a call credit spread um, or on the put side, either naked or as a spread, and that is what has paid me better. But otherwise, I'd rather just own the stock. So I hope that helps. Many options traders are saying they are better at writing options rather than buying calls and puts. I mean, that's what I would say for my limited experience so far as well. From Cyril, are we in a rest and potential consolidation phase? It seems that way. Looks like we're holding on so far, and some breakout can happen in the coming days. Yeah, the way that I'm describing it right now is I think that like the shorter term positioning risk on this market is actually to the upside more than the downside, but that the bigger picture like economic event risk is to the downside. So that's why the more we go up, the more market neutral I want to be. I am still net long at this point, but much, much less than I was a handful of trading sessions ago. And if we can really give that squeeze like I was talking about up to 560 to 570, there's a good chance I would become net short up there at that point. But for the moment, we are consolidating as the market seems to be going through a transition, like we've talked about, where we are exiting our event-driven bear market to see if we go into a cyclical bear market where we see more like economic growth slowing down based on tariffs and all these other policies. Cool, no problem. Over on the YouTube, over on the virtual trading floor, I want to ask about your rules for extension from the ADMA where you start looking for price correction, sure. So, it's almost like a mathematical law that when a stock or a market extends away from its equilibrium zone, and I define the equilibrium zone as a space between the 8 and 21 EMA, it's almost like a mathematical law that at some point the 8 and 21 EMA have to catch up. And in a downward market, the 8 EMA is going to be what I call a lower band of equilibrium. In an uptrending market, then the 8 EMA becomes that upper band of equilibrium. So that's the first part of the equilibrium zone that would get touched. So I don't have rules per se when it comes to stocks with extension because so first of all, what creates extension? Extension comes from the concept of momentum. Momentum technically means the greater the price, the greater the demand, or the opposite side on something that's going down. The more it goes down, the more that people want to sell it. Which I love that concept because it flies in the face of traditional supply and demand economics. So the more it goes up, the more it will go up because the more people that are going to chase. The more it goes down, the more people are going to want to sell because the more people are panicking out. But that can only last for so long. But if the profile of the stock matters so much. Like if you are looking at a quantum computing stock versus you're looking at Procter and Gamble, they're very, very different stock profiles. So, a couple percentage points of extension away from the 8 EMA and Procter and Gamble might be a lot, but a couple percentage points away from the 8 EMA in a quantum computing stock that can go absolutely berserk based on the right news could be a completely different degree of extension. So you have to know the stock that you're trading and the profile of that stock, and also news. The one time where really you see extended stocks become more and more and more and more extended is news. When news hits, because it's a whole event that is fundamentally potentially changing the profile of that stock. So stocks are individual stocks are very, very much on a case-by-case basis. I don't have rules on how I measure individual stocks extension. I do pay attention to day counting though. So if it's like a day one big move up where you begin to extend, it's like, okay, that's interesting. I'm not if I bought the beginning of the day at that day one and I caught it, awesome, congrats to me. Maybe that becomes a good swing trade and I can book a little profit and look for more. But I don't like the idea of shorting stocks on day one of momentum. Day two, I usually don't like trading them at all. If you're buying a stock on day two after day one was a really, really big day either up or down, you tend to have a worse risk reward and lower probability of success on either side. If you're buying the day two, it's just a bad risk reward and probability of success because it's extended because it went yesterday. If you're shorting it, it can very easily be too early because it just happens to be that way. You get the chasers that still come in on day two, and a lot of times you can really get blown out if you're trying to short just a stock on day two. Day three is where it becomes interesting. So not every name is going to give a day three. Sometimes day one is all you get, and then the thing fades, but I won't be involved in it because, like I just said, it's a bad risk reward at that point. But if you get two really big up days in a row, and then on day three you're getting another really big up day in a row, by that point you probably have a lot of extension on the daily chart, and it's that day three. A lot of times that's where I might consider going the other way on a daily chart for an individual stock. And I'm just speaking very broadly. It definitely depends on the circumstance, the news, just how extended it appears to be. But I don't really have a rule. The day counts I think are important and are a good thing to look at. But otherwise, I don't have a rule on extension for individual stocks and going the other way. And by the way, these rules on the 8 and 21 EMA extension, make sense on every time frame. You could take that trade based on the daily chart, which is usually what I like to look at, or in like a Netflix today, we were more looking at the extent. Today was a day one for Netflix, usually not where I want to short it. But even on a day one, maybe at a certain point I'll say, all right, this thing's so extended, I'm not looking to do this as a swing trade short, but I might be able to make a few dollars for myself on the short side on like a day trade. And that can be pretty dangerous. You got to be really careful, especially when there's big volume coming in like this. I always will say and think that the easier money in trading is to be with trend and with momentum. It's like I was just saying before. What was the easier trade today? Buying it through 950 like we talked about in the morning meeting and putting on a couple dollars worth of risk versus the low and making $40, or seeing this thing get super extended as early as 975 here and saying, all right, this thing is crazy extended on this 5-minute chart, the volume is picking up a little bit, let me start to short 975. And yeah, you know what, it was extended at 975, it was even more extended at 985, it was even more extended at 990 plus when it actually topped out. That's just it's a much harder trade. It has a worse risk reward and a lower probability of success than just going with the trend. But we tend to be, as a team here, pretty good at communicating actually some of those counter trend spots to be able to come in and make a few dollars. I typically am not trying to put this type of trade on with like a lot of money at risk, because it's just too much to lose. It's so easy to be wrong on these things. It's so easy to be too early. And Pat tends to be better at this than me on these like counter trend day trades. He's just a little bit more patient than I am. I think he likes to wait for the RSI to give him at least a certain number as well. Probably pays attention to the extension from the ADMA, the RSI, the volume that's coming in, multiple things coming in at once. And he definitely appears to, I don't want to speak for Pat, maybe we can get him to do an afternoon meeting on Thursday after the close. But he definitely lives by something that I talk about all the time with counter trend trades, which is that you are better off missing the trade entirely than being too early on that trade. So that's on individual stocks. Now, when it comes to the market, I do have, I don't want to call them rules necessarily, but I have guidelines that I pay attention to for extension on the indexes. On the SPYs and the Qs, if it's trading less than $5 away from the ADMA, I would rather be going in the direction of the trade. Meaning if the market is moving up and the ADMA is at 590 and the SPY is trading anywhere between 590 and 595, I would rather be a buyer than a seller. Again, this is just generally speaking. You have to think about the other layers of probability and everything else that's going on. But generally speaking, I view anything less than $5 away from the ADMA as basically not being extended, where you can be looking for trades in the direction of the movement. So it's an uptrend, it's less than $5 away from the ADMA, I could buy it. It's a downtrend, it's less than $5 away from the ADMA, I could short it. When you get to $5 to $10 away from the ADMA, that's the area that I consider to be no man's land. If you are $7 away from the ADMA on the SPY, you're a little bit too extended to buy at that point. Or if it's a down market, too extended to short. You just don't have a good risk reward. Because if it corrects to the ADMA or the equilibrium zone, which it easily could, it's going to pull back $7 against you before it even gets to equilibrium. So you're kind of chasing price at that point. You have a bad risk reward and low probability of success. But I also don't like shorting there. Because again, if you're going to be putting on a counter trend trade, which is what that is, if you are shorting upside extension or buying downside extension, it's a counter trend trade. Go back to what I just said earlier. You're better off missing the trade than being too early. $7 of extension can easily become $10, $11, $12 worth of extension. And finally, when you get to more than $10 away from the ADMA for the SPYs or Qs, that becomes the zone that I consider to be extreme extension. So extreme extension is where I will definitely not buy extreme upside extension more than $10 away, or shorting if it's more than $10 away from the ADMA, I will definitely not buy or short, and I may consider going the other way. And again, you have to really pay attention to everything else. What is going on? What is causing this? Like what we saw in this down wave here for the market. I'm just talking about the initial down wave, not the insanity that ensued in April. But what I was saying in this down move was, guys, $10 of extension I don't think is enough to buy, because there's like a fundamental event that's going on here with these tariffs. It's pretty bearish, and positioning. We knew that positioning, there was huge selling coming from CTAs, huge selling coming from vol control, huge selling pretty much across the board. I was like, guys, let's not be too early on counter trend buys here and buy a $10 extension. This environment seems more like a $15, $17 downside extension, which is going to be really extreme, but that's what we should look for to buy. And by doing that, if anyone remembers, we actually pretty much perfectly called out every low in this down move. Not that there were many, but we bought on the 28th near lows, we bought on the 4th near lows, we bought on the 7th near lows, and then at this absolute bottom here, I was too early by a few days. I think I started buying a little bit on the 10th, and we didn't truly bottom out until the 13th. But generally speaking, we did fantastically well by kind of using those extension guidelines. And guidelines is probably a better term than rules, because like I was just saying, it depends on the scenario. If you were buying the SPYs or Qs every time it got to $10 worth of extension on this way down here, you probably had to endure a lot of pain before you caught the move in your direction, if you even caught the move in your direction at all. And then when you go into a crisis, like the financial crisis or COVID or the Trump tariff crisis, then all of a sudden it's not impossible to see 50. I mean, what did we see at the most here? Like $50 a downside extension in this market. I mean, yeah, 55 in the SPYs. It was absolutely and utterly insane. But if you remember, we talked about it a lot. This Monday here on April 7th at lows was like, I think it was the most extended I've ever. I'm certain it was the most extended I have ever seen the market to the downside in the entirety of my career, and probably would have to go back to the actual financial crisis to see anything that rivals it. So extension guidelines, probably better than rules, are exactly that. They're guidelines, and you need to digest and understand them within the confines of everything else that is going on in the market, but they can be powerful pieces of information to bring into your study of the market. But you also want to remember that a market can remain irrational longer than you can remain solvent, and in extreme periods of crisis, you can get extreme periods of extension. And if you were, I don't know, buying at the end of the day here, I mean, how extended were we out of curiosity at lows on the 3rd? $21 at lows here on the day after, on that Thursday after Trump destroyed the market with the tariffs. We were $21 extended to the downside, which is like that's $10 is extended, is extreme extension. This is 21. And if you bought the market that day because your only reason was we were $21 extended, well, the low didn't come in for another $55 or so. But again, that's in a very, very rare calamitous period of time that typically only happens like once every decade or so. Though we've had the now fun of experiencing this 2 times in the last 5 years. So hope that helps with your question, Liam. Yeah, that's all I'm doing if I'm selling options. I'm really utilizing it to collect the premium. From Dave, for what it's worth, I bought Palantir calls this morning after you identified Palantir strength in the morning meeting, along with a fallout right above the market open, and I legged into a free debit spread by then selling a higher call to remove the risk. Cool. Good stuff. Good stuff, Michael. No problem, Liam. Pat maybe stepped away because otherwise I think he would have. I think did I like hurl an underlying insult there, but it was all in good fun. I'm sure he would have responded if he was listening to that. From Liam, I was asking Pat about it, but what are your overall thoughts on the Meta lawsuit? Seems ridiculous that they can sue a company for an acquisition that was previously approved. I've never seen a company have to break up before, other than rumors with Google. Yeah, I don't know. I don't have a strong opinion on it, mainly because I haven't done a lot of research on it, to be totally honest with you. I haven't looked at it enough to form an opinion, and I'm not going to give you an opinion on the fly if I haven't felt like I've researched enough. The biggest thing for me on it is that I feel like it's given Meta relative weakness recently, and therefore I've been kind of avoiding it on the long side. I think that there's just been better names to try to buy. Like this morning, I think we identified NVIDIA as some relative strength as maybe you could look at, or Apple maybe had some relative strength. Amazon we said we didn't like as much. Google we said maybe could be decent if the market goes, but Google ended up being a piece of crap. Meta, just with the drama that's ensuing and the resulting relative weakness, has just been something that I have been avoiding. I don't think I've ever seen a company have to break up before due to antitrust monopoly investigations, so that would probably be a new one for me. They've just been allowing these companies to get bigger and bigger and bigger. I don't know about Meta, but I feel really confident with Google that Google would be worth more broken up than it would be as an individual company. I think that the sum of the parts on Google are worth more than the whole. And I think with a lot of companies it tends to be that way. So that's why you'll see companies on their own sometimes spin off a company. So a lot of times, from my understanding, if you are like a multi-conglomerate company that has a lot of different businesses, they end up valuing you at the multiple of like the weakest business is just kind of my general understanding. I've never seen stats to back that up, but it's just stuff that I've read before in researching. So you'll see companies, purposely split off one of their businesses because they know it can get a higher multiple. I mean, look how well GE did overall by splitting up a lot of its businesses. So Google, I do think would be worth more broken down into individual companies than as a whole. Meta, I really don't know. I'd have to do some more research on it. Yeah, we'll see. I mean, the current administration is supposed to be like the very, pro-business, let's deregulate and fire everyone party. So would be surprised to see too much happen there. From Dave S. So it's like a way to trade options in a way that risk can be removed based on your trading style. Yes, yeah, for sure. There's definitely some ways to utilize stock with options or options with options at certain points in a trade to remove risk, but sometimes that means taking away some of the reward profile as well. What does Google being broken up even look like? You would just have like 3 different versions in your brokerage. Well, they would all get different symbols. So there'd be like there'd be Google, which maybe is the core business of search, and then Google Cloud gets its own symbol. Maybe that's, I don't know, GLC or something. And then YouTube becomes its own company and gets its own symbol. Maybe it's Tube, Tube. I don't know. And if you owned your Google underlying stock at the time of the breakup, then you, like in an investment account, would probably get proportionate amount of stock in each one of those companies. So your 100 shares of Google or whatever in your investment account maybe then becomes, I don't know, 20 shares of Google search and 20 shares of YouTube and 40 shares of Google Cloud and whatever else for the remainder. Yeah, I don't know. There's definitely some arguments to be made for these companies basically being monopolies. One argument that you could make for breaking them up is that they stifle innovation because they have unlimited amounts of cash. So it becomes impossible for other, like a smaller company that doesn't have the unlimited amount of cash that a Meta or Google has to, start a business that could compete because they can just, you know, even if Google or whatever is behind the startup company, they could just buy their way and spend unlimited amounts of money to get ahead. So that would be a reason to be able to potentially break them up. But tr- the interesting thing is that traditionally, you would want to break up a monopoly because of how it utilizes the pricing power of its monopoly to basically overcharge customers. But the interesting part about a lot of these huge companies that we have now is that um, their business has almost been the opposite. It's that they've used like these huge economies of scale to lower prices for the end consumer beyond what it would be if there were more smaller competitors out there that don't have the same scale advantages that those companies do. So that traditional argument of, hey, we need to break up this monopoly because they are killing everybody by charging whatever they want doesn't really apply to like the Amazons of the world, as an example. So hope that helps. Uh, Back over to the YouTube from AR. Uh, cool. No, just give everybody a shout out. Shout out to Pat. Shout out to the team. Appreciated AR. AKA Trade 117. Um, but this can be career ending if it continues like it did. I assume that you're talking about extension, and yes, it can. Like I was just saying, if you that's why you have to manage risk. You have to recognize that extension can become more extension. An extended stock can become more extended. A stock can remain irrational longer than you can remain solvent, and you always have to manage risk because 100%. If you were just buying, if your only rule in the whole world was I buy the market every time it becomes $10 extended, well then you were buying the spies at 547 at like the open on the third, and you could have totally blown your account up by the time that bottom actually came in. It could have been career ending for sure. So risk management is key. You have to manage your risk. You have to know your account size. You have to know your worst case scenario, and you have to be able to manage the trades properly. And that's why I'm saying these are guidelines, and those guidelines generally have worked extremely well for us as a team over the course of the last handful of years since I really started using them. Like with a tremendous amount of consistency. There was a period of time, and again, I pulled back a little bit in this down move on being aggressive on just going counter trend, and I tend to be less aggressive on the downside on that extension than I am on the upside. I tend to be more aggressive at $10 of upside extension in the SPYs or Qs versus $10 of downside extension in the SPYs or Qs. Over the course of my career, down moves always seem to happen, and there are exceptions. You can get parabolic up moves, but generally, especially at the index level, down moves tend to be much faster than up moves in real periods of crisis versus real periods of froth. Um, but there was a period of time where I went like several years where every single time we got to $10 of extension to the upside, like in the Qs, and I started shorting, I might be out of the money for a little bit, but just with the strategy that I was overlaying on top of the extension, I made money every single time I put that trade on for like several years before eventually having like a break even one or losing a little bit on one. But again, I wasn't necessarily doing it every single time. I'm being a little bit selective because obviously, had I done it this time on the way down, I would have gotten hurt really bad. But I was not just, on this day here, just starting a new position in the Qs because of how downside extended we were. Yep. Exactly. All right, cool. Looks like we got through everything, and it's almost 5 o'clock. It was a slow day today. I'm gonna wrap it up. Have a great night, everybody. Remember, no afternoon meeting tomorrow. No afternoon meeting on Thursday. So for anyone who only tunes in the afternoon meetings, we'll catch up with you next week. And that's all she wrote. So have a great night, everybody.